Welcome back to another edition of the Rural Radio Network's Trading Bits and Bytes. I'm Patton, in for Susan Littlefield. As we take a look at this week's markets, it's amazing to see the difference 1 week can make in the week's trade. Last week, big market fundamentals and macro markets driving. We saw the huge swings in the outside equities, as well as safe haven in the US dollar starting to run it up. Fast forward to 1 week here, and now we're starting to see things come back around. We've seen a decent little rally in the grains and a lot of the commodities in general as well. The equity starting to calm down a little bit. The Senate announces a stimulus, and that's brought the US dollar, reining it back in a little bit as well. Talking this week's trade on Trading Bits and Bytes is John Payne. He's Senior Marketing Analyst with Daniels Ag Marketing in Chicago, publisher of the weekly newsletter This Week in Grain. And John, as always, we do appreciate you being on the program. I think let's start here in the corn market specifically. It took a big hit last week as we continue to see crude oil and unleaded gas futures just plummet 20-30% down. Now going into this week, we see big ethanol producers like Ethanol, and they're saying, well, they're going to have to idle plants. They're going to have to shut down production because the margin just isn't there. Can we separate out the corn from the fuel markets?
I think in the short term, it's going to be tough to do that. It doesn't take a genius to know that when you look at 40% of our corn uses for ethanol and ethanol plants are idling, shorting corn is certainly a recommended strategy for a lot of folks when they hear that. I think you'd be a little careful over the longer run. The dynamic of feed here really matters. I think it's obviously feed isn't going to make up for what we're going to lose over ethanol use, but there is a DDG component to this where a lot of folks are going to find themselves either begging for wet DDG or going to have to switch to something else. And that could put more pressure on corn, more pressure on soy meal on the margins. I think that's a difficult argument to, with that in place, to see corn, say, north of $4 again without a weather problem. But, rationing supply here is a lot easier in the shorter run for farmers because it has a home. As we get into the end of April, those bin doors will need to open up and those folks will need to sell it. So I do think that we're looking at some price weakness into the end of April. But I think over the longer run here, don't discount the fact that ethanol can't be exported. Maybe this is a part of an export agreement to China. Who knows? But maybe we get back on our feet as an economy and gasoline goes back to $1.50 a gallon. I mean, those kind of things aren't being priced in right now. And I think, to be able to predict the future, you have to be able to predict when we're going to get back on our feet as a country. And I think that's the first step if you're going to be a corn bull here, is getting gas prices higher, certainly.
You talked a little bit about the soybean market there as well. That's one that really on the week we saw some decent upward movement and traction in it as well. But really, when you start to break it down, China's coming into the market slowly, and the latest USDA export numbers show that. Are we finally starting to get a little bit of movement on that phase one trade deal? And can we continue to keep these soybeans moving out of the U.S. ports, or are we going to see production shift to South America after we get over COVID-19?
Well, a lot of that depends on what the Brazilians and the Argentinians are doing. In the short term, I think a big part of the reason is production. Producers down there and truck drivers are not working. For the same reasons they are up here. So there are a lot of hurdles to get the bean meal and the beans from Brazil to the ports. U.S. offers are pretty much right in competition with where they're offering in Brazil here. And, the phase one commitments are probably going to be held up, at least especially as we get to the second half of the year. Beans, in my opinion, are a function of the dollar as well. And I think we've topped in the near term, especially against, the markets like the Brazilian real and maybe even the peso. The two stimulus packages we're going to see here are going to total $4 trillion. And I said a second. That's right. We're looking at a possible second stimulus package to come down 30 days if we're not back to work. Some of the legislators are already talking about that. I think that's tremendously dollar negative, and in a way, that's really good for the farmer. So it's weird to find yourselves in these dynamics when we all grew up kind of saying, hey, you don't spend more than you make. But in this environment, you almost have to root for it with the country because the dollar weakens. Our wheat prices go up. Our soybean meal prices are going to go up competitively against our South American neighbors. And that's how we get to $10 beans again. I think that in the near term, it's not just going to be fundamentals. Carryover is pretty close to where it was 3 years ago when we were trading at 10. So short term here, the dollar is going to be a big hurdle, but in the long run, I think this is a big opportunity to be doing buy side hedging if you're a feeder. locking in product, locking in energy. I think a lot of this is going to be inflationary come 6 months down the road. Because I'm in trading under the under the idea that we're going to get up and start moving around again. I think that to think that we're going to be in isolation for more than another month would be, I think, a little bit farsighted in my opinion.
As we take a look from grains over to the livestock trade as well, and Daniels Ag Marketing offers a full front for risk management services. So don't think we're only talking grains, because that's what you hear us talk Monday through Friday. John, you also closely watch the live cattle, feeder cattle, and lean hog trade. That we've continued to see these box beef prices just shoot up. The cattle slaughterhouses are running at max capacity, just trying to keep beef out to the retail side of it. Are we finally starting to see maybe the curve there in that demand, as well as people get their freezers stocked up and kind of are waiting to see where they go next with this?
Yes and no. I think that's more the case on the pork side. Pork is, I think, an easier product to be run on. We're seeing a lot of the retail cuts do well, but the processor cuts are not. So that, I think there's a problem with the cut out here in the near term. And I think cattle on feed, the quarterly hog numbers confirm that we just have a tremendous amount of product on hand. That said, June is still $25 below its high from a year ago, maybe even more than that. So I think you have to be a little bit, like I said, bullish here, just given where we are relative to where the summer highs usually are, especially given the amount of exports that China's going to be doing. On the cattle side, I'm bullish deferred feeders, and I'm bullish front month fat futures. So looking at April, I think April's going to rally. I would bet you dollars to donuts we're going to rally after first notice day, though. I think, maybe we float up to 110 here before the delivery, but once we go into delivery, I think April is the contract. You're going to notice it's skyrocketing on days, maybe even trading over above limits. So I think at this point, there's a lot of I don't say arbitrage going on, but like strategy, in the sense of, hey, you're going to pay me X amount of dollars. Why don't I just sell it all here and then buy it on paper? Because if it rallies, I'm going to get 150 from the FSA, and then I'm going to make it on the paper as well. That's a strategy you can look at. It's gambling, but in this kind of world right now, those opportunities exist. I'm not saying I recommend you try them, but they're certainly there. Especially when you look at a market like livestock, when the box beef spreads are blowing out here. We're going to need product. It's a no-brainer that they're not buying. They're going to be in here buying April fats. In my opinion, that's a sure thing.
Again, we're talking with John Payne. He's a senior marketing analyst with Daniels Ag Marketing in Chicago. If you'd like to learn more about their risk management services, visit their website. That's danielsagmarketing.com. We've been talking with John Payne, and we thank you for joining the Rural Radio Network's edition of Trading Bits and Bytes. I'm Clay Patton.